Hello, everybody, and welcome to our 2023 return stacking recap with Corey Hoffstein, CIO of Newfound Research, and myself, President of Resolve Asset Management Global. Hey, Corey, how you doing today?
Happy holidays, Rod.
Yeah, happy holidays. What a year we've had, huh?
This has been an exciting year. Lots of product development, lots of great conversations going on with allocators. It's been a ton of fun, and we're excited to share some of the things we've accomplished and all the things we're looking to get done in 2024.
All right. So just a quick recap. 2021, we got together, realized there's a need in the market for something like return stacking. We print and distribute the white paper, Return Stacking Strategies for Overcoming a Low Return Environment, with just a dream and a thought that you could use existing stacked ETFs and mutual funds that were kind of murky. Wasn't easy to discern what the stacks were. And we got such great feedback, such great reception that we decided to launch a business out of it. Returnstacked.com, which is portfolio solutions, and returnstackedetfs.com in order to provide some of the parts necessary that at least a low hanging fruit. So fast forward to 2023. What do we do?
First ETF out the door, return stacked bonds and managed futures. We launched this in February 2023. And this was one we were really excited about because it gave people the opportunity to maintain their bond exposure while overlaying managed futures exposure. For every dollar you allocate, our aim was to give a dollar of core US fixed income plus exposure to a managed futures program. And that's where we get a lot of questions, Rod. And maybe you can talk about some of the design decisions we made around what type of managed futures program we wanted to provide.
Yeah. So, first of all, why managed futures trend? It gave us a couple of benefits. Number one, when we look at the SocGen Trend Index or the B Top 50 or any kind of managed futures index, we find that they tend to do a really good job at filling in the clear gaps of bear markets for equities and inflationary shock regimes for bonds and equities, to be honest, right? In the spirit of keeping it simple, we decided to do trend replication. Now, there's a few methods of doing that. The trend replication that we decided on is on a universe of 27 different futures contracts across equities, fixed income, currencies, and commodities. And there's two ways that we went about it: top down replication, bottom up replication. We're not going to get into it here. We've written a ton on it. There's a white paper that we're going to provide links on. There's a couple of videos that we've done, interviews. We'll let the readers and watchers go into the links to get more detail. Now, maybe, Corey, we can talk a little bit about what happened once we finally had this wonderful stack together, ready to go to market, as is our fate.
If there's a golden rule in markets, it's that whenever you launch a product, you will run headfirst into the worst possible performance you could run into. And what we saw very shortly after launching the product in February was the regional banking crisis here in the US that saw interest rates plummet and bonds rally. I think it was the best 1 week return for US government bonds ever in the history, if not certainly since the 1970s, which meant that trend followers who had been predominantly short bonds because of the terrible performance of bonds in 2022 ended up having their worst performance on record. I believe the SocGen CTA trend index had one of its worst 3 or 5 day returns ever in the index history since 1999. And that's the performance we came out to. Since sort of mid May, we have, in our opinion, been tight to our mandate, providing core US fixed income exposure, very similar to what you would see with something like the Bloomberg US Aggregate Bond Index, as well as managed futures exposure that has been very similar to what you would see in the SocGen Trend Index, or just a diversified basket of large trend following mutual fund managers. And so we've been very happy with that. For people who want a little bit more decomposition of returns, you can take a look at our Q3 commentary. We do a really deep dive, a retrospective on where those returns came from, how they unfolded, exploring the different sources of tracking error. So for those who want to go deep, we'll provide a link below.
Yeah. Okay. So we launched the RSST, had a few rough months, had a few good months, and then we decided to launch the return stacked stocks and trend ETF. Now, we launched this stock and trend ETF with a focus on the beta, on the equity beta being on the S&P 500. So why don't we talk a little bit about why we made that choice for this second launch?
Yeah, so RSST was launched in September. This was really designed to be a sister fund of RSBT. Again, RSBT giving you $1 of bonds and $1 of managed futures for every dollar invested. RSST is designed to give you $1 of S&P 500 exposure plus $1 of managed futures exposure for every dollar invested. And the managed futures programs are managed identically. And so the question was why?
So when you think about, first of all, you want to have as much flexibility if you want to stack. And of course, S&P 500, given that it has the most weight in most portfolios, launching this S&P 500 plus trend allows people to really replace as much of their S&P as they can. But really then it comes down to, even within advisor books of business, there is diversity between the types of weights they give to equities and bonds. You can start with an 80-20 investor, 50-50, 60-40, 20-80. And so by having those two major parts to be able to play with, you can replace the proper amount of equities and bonds across that landscape with those initial two ETFs if you buy into the idea that trend is a thoughtful diversifier to equities and bonds, right? Okay. So that's RSST. We launched that in September. That quickly got up to $25 million, which was fantastic. And then the final one that we always had in our back pocket and wanted to launch here is the 100% stocks and 100% bonds ETF. Why don't you walk us through the rationale behind that launch?
The idea here is that this is meant to be a complementary core building block in a way that allows investors to sort of choose your own adventure, right? So the way to think about this, probably easily with a simple example, is if you are a 60-40 investor and you were to sell 10% of your stocks and 10% of your bonds and replace that with a 10% position in an RSSB, that 10% position in RSSB effectively provides you that stock and bond beta that you sold. But now you have 10% left over in your portfolio with which you can do anything. And that's where the choose your own adventure really comes in. While we have pre stacked solutions in RSBT and RSST, you may have another preferred alternative, or perhaps another managed futures manager that you prefer to our approach. And RSSB is really designed to allow you to then go on and stack whatever you want.
Yeah, that's exactly right. I think it's having those three core betas that we believe, and then you might have strong conviction on another manager. Hopefully, it's as diversified and non-correlated to even trend that you can continue to explore. So, with those three major parts, those building blocks, we felt like we needed to launch that in 2023. Those were the key elements to get 90% of the way there, the minimum effective dose to provide really powerful, well constructed portfolios. But of course, the next step for us was, okay, here are the parts. And a lot of people are saying, hey, can you help us with the assembly instruction? And so part of the project in 2023 for us was to build out return stacking portfolio solutions website, which allows advisors and registered reps to log in and actually see some suggested portfolios that they might want to track. And as we had more and more conversations throughout the year, we realized that not all stackers are built the same. We started recognizing patterns and creating some personas. And hopefully, this next part of the video resonates with some of you. You might be able to put yourself in one of those categories. But really, it came down to three basic personas. And we're going to walk them through now. The first persona is the growth stacker, then it's the diversified stacker, and the last one is the all weather stacker. Corey, why don't we start with dissecting the first one? What is that growth stacker category look like?
The growth stacker tended to be someone that was looking to stay tightly matched to their core target portfolio, call it a 60-40 or an 80-20, but wanted to stack additional returns for the pursuit of extra growth in their portfolio. And what I found with allocator conversations is many times these were financial advisors who were allocating on behalf of younger growth clients who historically have been allocated into 100% equities. And what these advisors were seeing was that return stacking unlocked the ability to have a more diversified portfolio through stacking bonds and managed futures without necessarily sacrificing long-term return expectation. In fact, they might even be able to enhance the long-term returns because they're adding these additional return streams.
Right. And I think one of the key things as well in those conversations are that when you have that type of client base and when you are looking at equities, there's always a tilt to those allocators to want to pick managers that pick better stocks or pick better stocks themselves. So they're trying to beat the S&P 500 benchmark by picking better equities. And that is certainly one way of attempting to do that. It's a very hard way. And if you think about it that way, if you're trying to beat a benchmark, you don't want to be too far away from it. You don't want too much tracking error, but you stack 10, 20% of a diversifier that has a positive expectancy, you have a different way of attempting to beat the benchmark, right, on the macro side. So I think that's another key piece of the conversation that has been very fruitful for the growth stack.
Yeah, so let's talk about the diversifying stacker, Rodrigo. These clients tended to be focused more on retirement rather than growth. These were advisors who were allocating for their clients who were subject to sequence of return risk because they were taking withdrawals. And 2022, I think, was a significant wake up call. And if things had been worse or been a multi year bear market, that could have led to permanent portfolio impairment. And so we've had a lot of conversations with people who are looking to add managed futures as a third leg of the stool, again, within tracking error constraints to that existing core stock and bond portfolio, but add that diversifier in not as a layer of generating extra return, but as a layer of adding extra diversification that will hopefully offset stocks and bonds, particularly during an inflationary environment. Now take us into all weather, Rodrigo, because this is I know these are your
My bread
people.
and
This is
butter.
your bread and butter for sure.
Yeah. Yeah. And I think for me, it's been my life's career to build all terrain, all weather portfolios, starting with a permanent portfolio. These conversations about how do I ensure that I don't get truly unlucky? What is the best approach to creating portfolios that are not going to blow me up? So, from the perspective of all weather, these tended to be individuals that had taken the red pill, that said, I don't care about tracking error whatsoever. I care about safe withdrawal rates. I care about reducing my adverse scenario risk. Where the lineup that we've launched, RSBT, RSST, and RSSB, can really fit in is in this concept of not only diversity, but risk balance. And I like to equate it to a motor. Normally, you have a two piston motor in a 50-50 bond equity portfolio. People think that they have two pistons in a motor that move in opposite directions and that they're equal width. But the reality is that because the risk in equities is so high, you have a very thick piston in that motor on equities and a very thin piston in bonds. So even though the bonds may be offsetting, the motor is really driven by the equity portfolio. The goal, step one, is to make sure that the width of the pistons are correct, give more to bonds, less to equities. And then as you start adding diversifiers like commodities and trend, you want to make sure you maintain that weight. And so the all weather approach is to create a multiple piston, well balanced portfolio that could keep on chugging along across any environment. Now it's the question of power. How much horsepower do I get in that motor? Because the problem with that is that story hasn't changed with or without return stacking. It's been around forever. The problem is that when you do that, you end up getting a well-balanced motor that's really tiny. It kind of chugs along and gives you, 6% returns because the diversity is so good that in the good years of the S&P 500, you're not participating in that and people feel left out. So you get a higher Sharpe ratio, but a lower absolute return. Return stacking unlocks the engine power. It actually allows you to build more powerful engines by simply increasing those weights pro rata beyond the 100% to hit different risk targets.
So 2023 has been an exciting year for us, right? We got 3 ETFs out the door. We are closing in very rapidly in $100 million allocated across the suite. We are incredibly grateful to all of our allocators, anyone considering the ETFs. We launched the Return Stacked website where we have a whole slew of educational articles and thought pieces for advisors and institutional allocators that are willing to sign up. We have model portfolios as well as a suite of tools we've built that people can use to learn, get their hands dirty, and learn more about return stacking. Rod, what can people expect from us in 2024?
Well, look, the first thing I would ask is everybody should drop some comments as to what they want to see in 2024. If there is something that is of real value, I think we should be hearing from the audience that got us here already, whether it's on model portfolio construction or on exchange traded funds that we should launch in the future. So I think in 2024 is going to be more thoughtful launches that are going to continue to round up the lineup. We haven't defined those yet, so I'm not going to delineate them here, but we do plan to expand that lineup. We are going to launch our Return Stack series, our Diversifier series in the model portfolio section of returnstack.com. You have to be registered in order to get access to those, unfortunately, due to regulatory constraints. But it's going to be more of the same, more education, more conversations with our audience, and hopefully, I don't know, Corey, do you think we're going to do some sort of event, virtual or otherwise, where we get the whole
I
Return Stack crew? I see the shirt that you're wearing.
I would hope so.
Or are we
I
going
was
to
gonna
do it
say the
remote?
last maybe for keen eyes may have noticed we're starting to mess around with some merch. So maybe we'll have some hats and some shirts and some quarter zips available throughout the year.
Yeah, we're going to drop a few key links for the content that we created that I think answers most of the questions that were asked. I'm actually going to drop a link to a tweet storm that Corey just dropped today, which goes through the main objections that we get and the answers. And honestly, if you just go through those, you should be 99% of the way there and be able to start making some thoughtful decisions about how you can use our lineup and the model portfolio section. If you guys have any questions, we have a large team of well educated people on return stacking, myself, Corey, Mike Philbrick, Adam Butler, Dylan Pierce on the sales team, and Richard Latterman. Like we have enough people to be able to answer your questions. So do not be shy. Reach out on Twitter, reach out on LinkedIn, reach out over email. We love to engage and love to provide bespoke solutions if that's something you'd like to do.
So with that, Rodrigo, I guess all we'll say is thank you very much, everyone, for such a wonderful year. Happy holidays, stay safe, and we'll see you in 2024.